I'm ready when you are.
All right, so basically, let me let's just move all of this out the way. All right, so we'll identify our demand zone. Let's just grab this here, and then we got a supply zone here. This is the SPY chart. So if we understand the prices between these two levels, then we have an understanding of what our strike price should be. Does that make sense?
Mhm.
All right, cool. All right, so price is what, 375.88, and then we have 388.67. Okay, so we were looking at SPY over the course of a week. It's possible that price could get back up to 388. Right, so we're looking for a strike in between 375 and 388. So we click on the trade tab, and tomorrow is Friday, so the week ends tomorrow, and so we were looking for a contract. We'd be looking at either Friday or Monday, which is the 18th. So Randy and Mike, this is the bid price, and this is your ask price. Right now, price is currently at 377.91. And then the aftermarket price, meaning the market closed at 4 p.m. And so after hours, the price is now 379. Can you see that?
Yeah, I see it.
You can see it. All right, also. So the strike right now is 380 for tomorrow, right?
Mhm.
So what happens is that every time you make a sell in the market, a sale of any sort, whether you're buying a contract or selling a contract, it's going to be someone on the other side of that contract. So you're going to buy the ask. So whenever you buy your contract, you're buying the ask price. And when you sell your contract, you're selling the bid price. Does that make sense, guys?
Mhm.
Does.
All right, so your bid ask spread is these two numbers, basically your 148 and your 145. So when you look at this 380 strike price, the spread is 3 cents or $3 because, you know, 1.48 is really $148 and
Right.
1.45 is really $145. So that spread is $3, right? So what that means is that if the market will open right now and we purchased this 380 strike price, that's a call because we're on the left side of the screen. What that means is that we buy this immediately at 148. If we wanted to sell it right back to the market, we would be losing $3. That makes sense?
Per contract.
Per contract, exactly.
Gotcha.
Now, when you're looking at the indices like SPY, QQQ, IWM, DIA, which is Dow Jones, and IWM is the Russell 2000, they typically have a very narrow bid ask spread, meaning that it's not going to be that big. It's going to be relatively somewhere between like $3 to $5, if that makes sense. If we look at something like, let me see, Rivian. So I'll go to Rivian. Rivian is the
New car company, the new electric car company.
exactly, it's an electric car company. Their competitor is Tesla. And so when you look at these bid ask spreads, these are pretty close too. See, the ask is $50, the bid is 45. So that spread is $5. Let me see something. Let's go.
And how long is that contract for?
This is July 15th. I'm going to find
Okay.
you one that's a bit wider so that this makes more sense. Let me think of something. Let's see what Tesla looks like. All right, so Tesla, this is a little different. So Tesla's price is at $714.94. And so because the price is so much, the bid ask spread is a little bit higher. So you could buy the ask price for the 717.5 strike price, that ask price is 8.5, right? And you can sell that for $8. So that bid ask spread is $50. So if you bought this contract at $850 and you wanted to sell it immediately back to the market, you would be losing $50 on that contract without any price movement, essentially, right?
Yeah.
Another example is let's look at JP Morgan. They had earnings yesterday. Nope, not them. All right, let's see something else. Let's look at Oxy. Was it Lululemon? It's gotta be something better here. All right, so Lululemon, right? The price is Lululemon is an athletic, it's a clothing company
Yeah.
that specializes in athleisure wear. I guess for women and men, I'm not sure exactly. But the price is currently at $278.99. And then you have your ask price for the 280 strike, meaning that if the price were to go over 280, you'd be trying to buy a call.
Right.
If you purchased that, that'd be 272. If you sold it immediately back to the market, it'd be 217. So you're looking at a bid ask spread of about, what is that, $60 or so? $50, $60.
Yeah.
That makes sense.
It does.
And so when you think about the bid ask spread on an index like SPY or like the Qs, that's typically like, you can see now at the, what's this, 379 call price. You got 190 for your ask and 189 for the bid. So that's only $1 bid ask spread.
Right. So
So
generally with like the indexes, and because of the shorter time of the expiration date, those that bid ask spread is probably gonna be small.
Well, let's see, that's a good question. So let's go out a little bit further. If we go out to the monthly for August, which is August, what is it? So the monthly for August is August 19th, and we know that because you see there's weeklies here, and then there's nothing for August 19th, which means it's a monthly. So we open that up, and the bid ask spread is still typically pretty small. You can see for that 379 strike price.
Okay.
If we were to buy a call, you have 1156 on the ask side and then 1152 on the bid side. So that spread is $4. On the put side, if we were to buy, like, say, for example, the 375 put, you have your ask price is $9.99 and then your bid price is $9.95. So that's still a $4 spread, even though we're a month out. So the time
Okay.
is not, it's not impacting the bid ask spread in this particular example. That makes sense.
It does.
All right, cool.
So
All
in
right.
general, these bid ask spreads for these indexes are going to be not big, not large,
Like narrow, yeah.
narrow,
Small window.
unless the VIX gets out of control.
Yeah, so the VIX is our volatility indicator and it's the inverse of SPY. And so when VIX is going up, SPY is going down. And like what that looks like is here. So this is our SPY chart. Let's move this. I have another layout. Let's try this one. So if we look at the daily chart on both of these, so zoom in here, zoom in here. Essentially, you can see that, you know, if you see the cursor moving up, SPY is going up into uptrend while the VIX is going down. And when SPY goes down in the downtrend, the VIX is going up. You see that?
Well, I shouldn't be saying VIX. Maybe I should be saying the theta.
No,
I mean, not the theta, but the theta delta.
no.
Um,
So what's happening is that VIX is our volatility indicator. It tells us how much fear is in the market. And
Right.
so when VIX gets to be, so right now the VIX is at what, 26.40. When VIX gets to be around this 30 level and higher, it represents that there's a lot of volatility in the market. And what that means is that when you look at the option contracts, these prices will be a lot higher.
okay.
And when VIX is cheaper, like let's say, for example, 26 and below, 25 and below, sometimes even like 20. So if we like back up for a second, we can see back in March, since March 28th, 29th, the VIX was around $20 here. And so basically like what that means is that when the VIX is this low, the option contracts tend to be a lot cheaper. So instead of like 190, you're looking at prices that are more in the space of like $19, $20, $30.
Got you.
And so you want to be mindful that when the VIX is higher than 30, that's going to impact the prices of the contracts. Okay.
Got you.
All right, cool. So swinging back to the option chain, we have two layouts we're going to go over, right? First, I want to touch on volume and open interest, and then I'll touch on delta, theta, gamma, and vega. We understand that if you want to look at a different ticker, you want to change the price in this area here. So if you want to remove SPY, you just hit backspace and you type in something like the Qs, press enter, and then it'll pull up the option chain for that particular ticker. You guys cool with that? You understand that?
Yeah, I get it.
Yeah. Okay, so we type in like what happened? We type in like Netflix. It'll pull up the Netflix option chain, right? If we type in SPY, it will pull up the SPY option chain, right? If you want to see more options for strike price, right now we can see 364 down to 391. We can just either hit the drop down arrow and click the options that are available, or you can type in something manually like I did. I typed in 30 and now it's showing me 30. That makes sense?
Mhm.
It's going to show you 15 that are in the money and then 15 that are out the money. It's always going to split it evenly in that kind of way. So if I go down to, let's say 10, it's showing me 5 contracts that are in the money and then 5 contracts that are out the money.
Okay.
All right. On this left side, these are calls. So if you think the price is going to go up, when you look at your strike price, you want to purchase on the call side because your position is that price is going to be bullish and it's going to go upwards, right? If you think the price is going to go down, you want to buy on the right side, which is for puts. That makes sense?
Mm-hmm.
All right. In blue, these are considered in the money contracts, meaning that the current price is above the strike price. So for example, price is 377.91, right?
Mm-hmm.
If you look at 370, this 370 strike price,
Then
it's
add.
blue because currently price is higher than your strike price, which means that you're in the money. Right?
You said prices are currently higher than your strike price?
Yeah, so if price right now
377.
is 377, right? And you had a strike price at 370, you bought a 370 call, say today or like say Wednesday. 377 is higher than 370.
Right.
So if at any time the current price is higher than your strike price, you are considered in the money. And when you look at the option chain, your strike price will be blue. And when you're looking at the next strike price immediately after what's going on in the market, so right now we're at 378 and we can see the 379 contract. This
Mhm.
particular contract is considered at the money. Like you're getting ready to be in the money, but not quite.
Right.
And then anything higher than that, so like 380 and higher, these are considered out the money, meaning that the current price is not arrived at that particular strike price yet. It's lower.
Okay.
That makes sense?
Yeah,
Y'all have any questions about that so far?
I follow it.
Okay. So when you're on the put side, basically the same thing, but the inverse. So if you have a strike price of, let's say your strike price is 380 and the current price is 377. 380 put is considered in the money because the current price is less than your strike price.
Okay.
And if you have something that's like a 375 put, this would be considered out the money because 377.91 is higher than 375 when it should be lower. So that's considered out the money. So basically it's the same thing. It's just the inverse of like the call. The color code, if you guys pull up your option chain on your side, will be really helpful. If it's blue, that's in the money. If it's black, it's out the money.
Right.
All right, cool. What else do I want to show you? So you have two things that are happening here. You have open interest and you have volume. Open interest is essentially contracts that are open right now. So today the market closed at 4:00 p.m., right?
Mm.
As of the close, they're currently, where are we at? This is, so for the 379 call on the left side, it's 8,940 contracts that are open, that are active right now. Which means that tomorrow, there'll be people trying to sell this contract to somebody. Because you don't want to let this expire. You want to make sure you cash out before it expires. You see this number? 8,940.
Mm-hmm.
Yeah.
And the volume represents the amount of traffic that has happened in the market for this particular day. So
I know I asked you this before. Value, that number, does that represent shares or is it just transactions? So it's like
it's
88,000
like
transactions.
it's activity. Let me see. I got a slide deck here. So open interest is the amount of contracts that are active and not settled.
Mhm.
And the volume refers to the amount of contracts that have been traded in one day. So when you look at volume, these have been opened and closed today. Or maybe not open today, but they've all been closed today. So it's your settled contracts.
But one person
versus
could have had,
your-
I'm sorry.
Yeah, so one person could have had like 20 contracts.
Right. Okay, gotcha.
Yeah, or somebody could have had 200 contracts. And so that's going to be a part of that number. So is this thing changing? Oh no, here we go. So the volume is 88,475 and the open interest is 8,940, right? This is important because when you buy a contract, you want to make sure that it's a lot of open interest and it's a lot of volume. That lets you know that there's a lot of liquidity in the market, meaning that if you buy it, there will be somebody available to sell it to. That makes sense.
Mhm.
All right, cool.
What's a good number?
So when you're picking a contract, like for example, you see this one here, 379, it's at 89.40 for open interest, but then you go down to 380, it's 49,000, and the volume is 185,000. So basically in the market, you have these things called cycle levels. And so your cycle levels would be like 365, 370, 375, 380, 385, things like that, right?
Right.
So when you look at 379, that's a lower open interest and volume level compared to the psych level of 380, which has a bigger open interest and a bigger volume. Other examples are, let me think. So if you look at Apple, so you see here at the 150 call price, you got 57,000 on open interest and you got 76,000 on volume, right? Right now, the price is at 148. When we scroll down to what is this? 167.5. You can see the open interest is 1 and the volume is 0. Right? When we look at the 170 call price that expires tomorrow, we have 20,000 on open interest and we have 71 on volume. So right away, we know that we're not going to go to 170, right? Because the numbers are not high enough, when you can see very easily that a number like 150 has way more activity than a number like 170. That makes sense, Randy?
It does.
I understand it, but I don't know if you already said it. Why is that? Why the lack of value?
Why is what?
Why the lack of value?
The lack of volume, because when we look at the Apple chart, so if I swing over to the charts and I type in Apple, right now, Apple, so this is your 170 level up here. And then this is your 150 level down here. So if this contract expires tomorrow, is it possible that Apple's going to run $20, right?
Yeah.
It's probably like a 1% possibility. It's not really accurate because the market is not, it's not really bullish right now. That makes sense. I mean, we're in a bullish uptrend, clearly. But the chances that the market closes tomorrow on Apple is above 170, it's not very likely, which is why the open interest and volume are smaller than, say, open interest and volume for 150. Is that making sense, guys?
It does.
So a lot of this is based on price action. So where's the price at currently versus what's available on our option chain? And so when you look at the 150 strike price, right? And you're looking at the bid ask spread, so $50 for the ask, 52 for the bid. You see the open interest is 57,000, the volume is 76,000. But that's because the price is pretty close to 150. When you look at 170, that's $20 out. Your ask price is $1 and your bid is 0. So it's not a lot going on here, right? The volume is 71 and open interest is 20,000. So this would not be a good idea to buy this tomorrow, especially if we're at the July 15th expiration date, because today is July 14th. We don't want, you know, knowing how Apple has moved in the last couple of weeks, like on average, this is moving about 145, 147, about $2 to $5 a day, 142, 146. So if it's moving on average $2 to $5 a day, then it possibly moving $20 on a Friday. It's not quite, it's realistic.
Mm.
All right, so if we click on layout and we go down to delta, gamma, theta, vega. When we click on that, now we can see that we have the ask and bid price that's still present. But now we don't have open interest and volume. Now it says delta, gamma, theta, and vega. Right? And so when you think about these option premium prices, and you think about just from a perspective like, okay, how is this price created? This price is created based on the Black-Scholes model. And the Black-Scholes model is based on the option Greeks. I think it's about 6 option Greeks total, but it's really just 4 that are like really, really important to how this price is generated. And so the delta, basically, if you look at it like this, so we're looking at Apple and the price is 148, and we're looking at a strike price of 150. The delta is 0.34. what we can say is that there's a 34% chance that the strike price of 150 could expire in the money.
Right.
So looking at delta, it's 0.34. The strike is 150, right? This
Mhm.
contract expires tomorrow, July 15th. If the price is 148 and the strike is 150, as of right now, we have a 34% chance of this expiring in the money, meaning 34% chance profitable. That's a good way to look at delta, right? When you
Okay.
look at gamma, gamma shows you the rate at which the delta can change. So the gamma is based on the delta. When you look at theta, theta is based on time decay. So tomorrow, this contract expires. If we see that the ask price is 55 and the theta is 54, so
Is that a negative
55,
54 though?
yeah, 55 minus 54 is 0.01. So basically, if this expires tomorrow, you would lose $54 from this $55. So it's based on time decay. So if we look out, this is July 15th. If we look at July 22nd, which is next Friday, same strike price, different expiration date, right? So strike at 150, say we get a call, it's gonna be 219. The theta is $17. And so basically what that means is that if tomorrow comes and price is not 150, we could possibly lose $17
$17.
of the 219. That makes sense. So now your contract goes from 219 to now being 202. All right, so for Vega, Vega is based on implied volatility. So for every 1% that Vega moves, that will impact the option premium price. And so if you guys remember when we did our watch list columns, let's see. So you see this watch list here?
Mhm.
These are our sector ETFs, and we can see our implied volatility here. And so if SPY is 25.93, and then say, for example, SPY grows in implied volatility from 25.93 to 26.93. If that happens, that will impact the option premium price, which is your ask price.
Yeah.
All right, so understanding what these four are, and we have, if I scroll down some, let's see. So in this deck that I'll send to you guys, it's like a brief example of each one of these, the delta, the gamma, the theta, and the vega.
Mhm.
So you can refer back to it later. But basically, those are the four, most
Yeah.
important Greeks. But I would say that I really focus on the delta and the theta. And so if I'm looking at SPY, which is what I'm looking at on a daily basis, I'm trying to find deltas that are like 25 and higher. So, for example, prices at 377.91. You see right here where it says 0.24.
Mhm.
This is a 382.5 strike price on the call side. And so the price of that is $70 and the delta is 0.24. I want to buy this over, say, a 383 because that delta price is, it's less than 25. It's less than 25. You get that? And so,
Yeah.
like, if you look at, it's 377. The delta here for a 379 strike price on the call side is 0.49. this means that this contract was going to be profitable a lot faster than this contract. So a good way to think about delta is just, you know, like probability. So 49% chance to expire in the money, 24% chance to expire in the money. Y'all got any questions on that? On delta and how that works?
No, I get it. I didn't understand the meaning of it prior, but now that you just went through it, I get it. I get that.
Get that?
I understand how it factors in. I'm still a little stuck when I keep looking back at the bid and ask. So right there where you are on that 70, right? And the ask is 70, it was 70 cent, right?
Mm-hmm.
But the bid is 68.
Mm-hmm.
This is a call.
It's a call, yes, because we're on the left side of the screen. That's right.
It's a call. If it's currently at 377 and the strike price is 382.
That's right.
I'm trying to figure out, I know you said you would, because of that delta, you would be more inclined to take that versus the one underneath of it. But
That's correct. Yeah.
I'm always thinking about the money. I'm trying to figure, okay, cool. You're more inclined to do so because the percentage is a greater chance. I get that, but it ain't much money to be made there though.
Why do you say that? Why did you make that last comment? It's not much money to be made there.
That's why I'm stuck. I'm stuck. The difference between that bid and ask. It's so close.
So when you buy a contract, you're buying the ask price.
Right.
And when you sell the contract, you're selling the bid price. So the idea is that if you buy at 70, typically you wanna cash out at a higher price so that you can have some kind of profit, right? So if I buy at 70, I would love to sell this at 150, right?
Right.
Now, when I get to that 150 price range, this bid is going to be comparable to the 150 price range. So the ask may be 150 and the bid might be like 148, 147. So the spread means that the difference between the two. So if this ask goes to 150, the bid is going to grow as well. It's not going to stay at 0.68. It's going to grow with it.
Okay.
Right. And just like when it goes down, like say, for example, you got in at $70 for 382.5 strike price, but now price is not going up, it's going down. So now your contract, say it was at 70, but now it's only worth $50. So now you lost $20, right? This ask price could be 50, while the bid could be like 0.47, 0.48. That makes sense?
I get it.
Randy, you with me?
Yeah.
Okay. So looking at the option chain and understanding your strike price, understanding you got calls on the left, you got puts on the right, understanding in the money contracts, out the money contracts, understanding your option Greeks, you got delta, gamma, theta, vega, and then you got your volume open interest. What kind of questions do you guys have so far?
I don't have none currently, not in relation to any of this right here.
No, not for any of this right here.
Okay.
Yeah.
All right, cool. Let's see what else. Let me think. All right.
Will you go into that graph? You know when you execute the option, and then you can see the graph, or you can see where you are can you, where it's got the two lines, where you can see where, like for instance, if you know what I mean, you got, you win a call, you purchase a call,
Mhm.
and let's say you purchase a call and it's good for a month, and you're watching it. There is a graph on here that you can look at that shows you like how prices, you know, relation to, and then they'll intersect like that. So you'll see where if you know, if your price is at, if you're, you know, if prices it has increased, and you can see how much your contract is worth at that point.
All right, cool. That's a good question. I'll go through that whole workflow. So let's swing
You-
back.
Did you understand what I was saying?
Yep.
You did.
So basically, you're talking about analyzing your contract.
Yep.
Yep. So if I type in SPY, if we understand, just looking here, we'll look at a monthly contract, Randy, but say tomorrow.
Well, whatever contract, it doesn't matter.
Yeah, I'll go through a whole example. So when I went over that Nike video, that Nike contract, I went through that whole analyzing the contract. So we'll just set up some potential price targets. So we'll say this is a price target. This is the price target. And then say this is the price target. So we got 3 price targets. And then we'll have, the idea is that, oh, this wouldn't be a price target. This will be our entry. So that's our entry. And let's say our stop price is at the top of this demand zone. So we'll make this stop. And we'll make it red. So basically, tomorrow the market opens up. If price goes above 379, we'll enter this position, and then we have several price targets, right? We have a stop price. And so we know that if we enter above 379.05, we're looking at a strike price of at least 380. So
Right.
looking at the option chain, looking at, let's say, an August monthly, so August 19th, you can see these are a lot more expensive. Look at that. See, $10.99, that's at $1,100 for a 380. You see that? So
For one contract.
one contract. So if we right click on it and click on copy and go back to our charts, we can throw that contract on this right hand side of the screen, do a we just copied it so we can paste it. To paste it, you would do Control V. And so if we look at this on a weekly time frame, because it's a month out. So let's let this load up for a second. All right, cool. So right now, oh, that's pretty high, 16.6. So right now the price is at 10 point, what is that? Let's say $11, 10.88. This is what price is at right now. And so potential areas where price could revisit, right? If we got to 40.24, that'd be a 4x return, because right now price is at 10.88, right?
Mhm.
On the left is our stock chart, and on the right is our premium chart. Y'all get that?
When you say premium, the contract chart.
The contract chart, the option premium contract,
Gotcha.
right? So you'll see that both of these charts tend to look the same. So if I go to the weekly chart here, you see how we have this big move. You see how we have this candle here? This is a 2 up that's going down. And over here, we got a 2 up going down. We got a big move to the downside. And then we got a big move to the downside,
Mhm.
right? We got a slight gap here. We got a slight gap here. And then we got a bunch of consolidation right here. And then we got a bunch of consolidation right here. So your contract chart is going to be similar to your actual stock chart. Now, this is true for a call position, meaning that we think the price is going to go up or price is actually going down. So this is going to look similar. But if we type in a P here instead of a C, so remove the C, type a P for puts, press enter. Now we got a bit of an inverse. Y'all see that? So this 2 candle here, 2 down, going down. This is your white candle right here. Your big move going to the downside. This is your big move going to the upside. So it's basically the inverse. Y'all see that?
Yeah.
All right, cool. So now we see what the chart looks like for a call position and a put position. So I want to make sure you guys understood that. We go back to our trade tab, and instead of right clicking and clicking on copy, we're going to right click and click on analyze. You go to buy trade, and we're buying a 380 call for August the 19th, right? So we want to see what that's going to possibly, what the profit could possibly be before we actually buy that trade. So you
Right.
click on analyze, you go to buy trade, and you click on single. When you get to this screen, you're on analyze. Right now, that's on fundamentals. You want to make sure you click on risk profile,
Okay.
right? So at the bottom here, let me delete some stuff. Let's delete this and let's delete that. So at the bottom here, we can see the contract that we're analyzing. This is a SPY August 19th expiration date, a 380 call, and we can see the current price that it's going to cost us. I see that?
Mhm.
SPY August 19th, 380 call, it's 10.99, right?
Okay.
All right, so the power in this particular screen is being able to understand what your potential profit could be and your potential loss could be. So automatically, it's going to give you a positive 10% and a negative 10%. But we can alter these numbers based on what our chart tells us, right? So an example of that is we go to our chart and we want to type in our stop price. Our stop price is 375.88. So I'm going to go back to analyze. And at the very bottom, I'm going to type in 375.88. And so automatically we can see, looking at the PO open column, if price were not to get to this 380 strike price, we will lose 148.20. That's how much money we will be losing. Now we can type in our entry price, which is 379.05. So go back to analyze. Now type in 379.05. Then I'm going to just type in the rest of our price targets. So we got 381.92. So I'm going to type in 381.92. We have 2 more prices. So I'm going to add another row. We got 386.16.
Mhm.
So to add a row, I'm going to click on this plus button here on the upper right hand side. It says add slice. Click on the plus button.
Where is it? I'm sorry, I missed that.
You see this plus right here, Randy? It says add slice. You just press it and it adds a row at the bottom here.
Oh, okay. Show that. Now I see your mouse. Show it to me one more time.
And I'm gonna delete them so we can
Oh,
see.
you know what? I got this.
Delete.
My joint is in a way.
and delete. All right, so if we click on this plus, let me know when you're ready, and then I'll show it to you.
Okay, I'm ready. I
Ready?
see it now.
All right, so you click on the plus to add a slice.
Okay.
And then at the bottom, we could type in the next price. I think it was like 386.16.
Isn't that out of order though?
Yeah, I'm gonna show you how to rearrange them as soon as we finish adding the prices.
Oh, okay.
So we got 386.16. Our next price target is 388.67. So I'm gonna type in, hit the plus button, type in 388.67. And now when you click on this, see these 3 lines beside the plus to the
Mhm.
right? Click on those 3 lines. And then the third option says reorder slices by price. So you click on reorder. And now we got our lowest price at the bottom and we got our highest price at 388.67.
Was that another right click?
No, I clicked on this
got
menu here. I clicked on reorder slices by price.
Okay.
And then they put our lowest price, 375.88 at the bottom, and then our highest price, 388.67 at the top.
Okay. That should
Right.
stop at the bottom, at the very bottom.
That should just stop.
That should, the
The
next one is your
entry.
entry.
And then these are your price targets.
Okay.
Got it?
I got
So-
a quick question. Can you hear me?
I can hear you.
Yeah.
Yeah, go for it.
Oh, no, prior to you doing all of that, I was looking at what the deltas were. Prior to you doing any of this, when you arrange the strikes and the entries and all that, the deltas was much higher, right? So when you enter, I understand that they changed, but I don't remember why it was high. What was that number that was in there before you even got started? Was that something that just,
All right, so let's swing back here for a second.
was that just the overall contract itself?
So we have a
88.
we got a 380 strike price.
Mm-hmm.
And the delta currently is 50% or 0.5 for the
Right.
delta for this contract. When you get to the analyze tab, and we start to add in these price targets,
Mm-hmm.
you can see that the delta grows more and more.
Mm-hmm.
And so essentially, the idea here is that the price is at, where is the price at? What was it, 377? All right, price is 377.91.
Mm-hmm.
Our strike price is 380, right?
Right.
And basically what this analyze tab tells us is that if the price were to expire at this particular price, so for example, August 19th comes, our contract is a 380 strike price, but the current price is 388. So we're $8 and some change in the money, right? If we
Mm.
only bought one contract, looking at the PL open, we could stand and make $540 per contract. That makes sense.
I get it.
If we got to a price of 386 instead of 388, we can make this 383.97. You can see at our entry price at 379.05, we'll be losing $7. Not right now, it's moving because futures are open right now, but basically the idea is that at your stop price is going to show you what your risk is. You got your entry, and then you got your potential price targets.
And what did
Right.
each contract cost?
Right now we're at
Yeah.
10.99, so that's $1,099.
$1,099. Okay,
Yeah, because it's times 100,
right.
right? And so if we were to buy 3 of these, we just swing over to where it says +1, and
Mhm.
you press it up twice. So now there's 3 of them,
Right.
right? And now if you look at, if price were to get to 388.67,
Mhm.
now your potential profit is $1,612.
All right, so now I'm a little confused. So when you did that, the delta went up, way up.
Delta did go up. And to be honest, I'm not quite sure why. I do not have the answer.
I thought
Because
as
I'm-
price goes up, delta goes up.
I'll have to research that. I'm not sure why delta is this particular number.
See, I thought delta was a percentage, was more of a probability thing, the likelihood of.
It is like a probability thing. I have to circle back on that with this analyze type and understand like why delta is 189.
Oh shit, we stumped you.
Yeah, you did. Yeah, I'm not gonna make up anything. I'll tell you guys. I don't know why delta is that number right now.
So
I
I-
have to check
I
into that.
thought as price goes up, delta goes up.
So delta basically means like you're looking at the probability of this expiring in the money, right? And so the analyze tab is assuming that the analyze tab says if price gets to 388.67, our top price target, then delta will be at 189, meaning that we should essentially be 189% higher than what our strike price is. Right? We're in the money at this point. If yeah, I'm gonna have to research. I'm not sure why it's so high. I'm just giving you like hypothetical what I'm thinking right now, but I'll check into that and see what's going on with that. If we increase the contracts to say 5, you see this PL open is changing. That's that. So if we go to 10, look at how the number is adjusting. So we probably spent what $10,000 on this particular position, and we could stand to make $5,000 off of it as of today. And this is the graph that Randy was talking about. Let me try to expand it a little bit. I don't know why it's doing that. How do you expand this thing? Expand and then recenter. So we have 2 lines here. If we change the date, we have a date, what is it? I think it's this date here. So let's change the date to August, like 12th. And so basically what happens that is, what's this price? At the bottom is the price axis for what the current price is. And then as you move up the line, it's showing you potential profit based on price moving in this direction. So if we look at 388.67, right? And we look at it over here on the axis, you can see that this 5,000 lines up with this 5,000 here. You can see that. And so basically, the point of this graph is to show you what's possible if price were to go in this direction. And so why you use the analyze tab, you will use it to say, okay, I'm looking at my chart. I see what's possible on my chart, right? If I think that price is going to go up and increase by X amount of dollars, I want to know how much money I can stand to make or how much money I can stand to lose. When you look at the analyze tab, you type in your numbers, you got your stop number, your entry number, and then 3 potential price targets. It's telling you in the open how much money you can stand to gain or lose based on the number of contracts, which is here, that you have open, okay? That makes sense?
Yeah.
It does. Yeah.
All right, cool.
I just needed to see that again. Thank you.
Yeah, so the analyze tab is really just to give you an idea of what's possible.
Okay.
Now, if you were to analyze a different contract, you would just go to trade and say, for example, you got the 380 call. Now you want to check out the 375 put. So you right click on that, you go to analyze, you go to buy trade, you go to single. You'll notice that now you have 2 contracts at the bottom. You got your 380 call and you got your 375 put.
Right.
In order to see what's going on with the put, can I make this bigger? All right, cool. So you want to turn off the call. Turn that off. And now all you can see is the put.
Okay.
and then you want to change your prices to represent the put.
Right.
That makes
Got
sense.
you.
So same price targets, right? But you can see now at 388, instead of making $5,000, we're at negative 348. Y'all see that?
Yeah.
So negative, 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 and then once we start to go down to 375, that's when you go into positive. Why is that? Because it's a put contract, not a call contract, meaning
You wanted to
the
go low.
idea is that you want it to go down, right?
Right.
Now, if we adjust the contract, so this contract is 9.99, meaning it's $1,000. If we bought 5 of these, look at how the price changes. So now you spent $5,000, but you can stand to make $800. Well, 759 on this this particular price target here, 375.88.
Where's the chart reflecting this real quick?
What you say?
Where's the chart? I just the chart to see if that would be a good contract. Would you want to actually do that? So
All right. So if we go
Yeah,
back to our
point.
daily, let me see. I'll show you. I'll show you some price targets to see what's possible. So this would be your 375 put on this side. So 375. All right. Let's go to the daily chart. So now we got our daily SPY chart on the left, and then waiting
This
for this to
contract
load.
expires tomorrow.
No, this is your August 19th.
Oh, okay.
So it's a monthly contract.
Uh-huh. So
Right now we can see that over the last couple of days, for the last 2 days, SPY has gapped down and then it's come back up bullish during the day.
Uh-huh.
And then today, same thing happened. SPY gapped down, then they came back up bullish today. And so that's why you have these two candles. They basically were bullish and then they became bearish. So it was a 2 up going down, and then today a 2 up going down. Y'all see that? And so tomorrow we were to go into a bearish trade, which would be in favor for this 375 put. We would have a price target of here, 371.04, 370.18, and then this one, 362.17. So like those are our possible price targets. Where did they go? All right, so we got 3 of them. Y'all see that?
Uh-huh.
All right, so we go back to the analyze tab. I'll type in 371.14. So I click on the plus button. I'm typing 371.14. And then what's the next one? Oh, it's 0.04. 371.04. Then click on the plus again.
Can you show us those again? So you got 371, that's your stop, right?
So your stop, let's say we have the same stop, 375.88.
Oh, okay. I got you.
Our entry could be 371.04.
Uh-huh.
Our price target could be 370.18. So I'll
Uh-huh.
type in 370.18. 370.18. And then the next one is 362.17.
Uh-huh.
So I'll type in 362.17. I'll click on the 3 lines. I'll go to reorder slices by price. We can see now everything is in order, right? Knowing that we have 5 contracts at $1,000 a piece, if price were to get to 362.17 and we have purchased a 375 put, that means that we would be in the money, and this is what our profit could possibly be. It could possibly be $4,000. If The
How
contract
does that look?
expired.
How do those numbers look towards your risk to ratio?
So if our entry is 371 and our stop is 375, this is about a $4 spread here. And so 371 to 362, this is what is that, $9? So that's like basically like a 2-to-1.
2-to-1, it is, yeah.
A 2-to-1. If we had a stop price that was like a bit closer, so 371, and say our stop was at 372. Where is it? Like say this is our stop price right here. And so basically, you got your entry at 371, you got to stop at 372, so that's $1, right?
Right.
And if it gets to 362, that's the 9-to-1 ratio.
Ratio. So,
makes sense.
and I just always want to be up on that. I always want to make sure that I'm monitoring my risk ratio. You know,
Absolutely. You
I
want to
can
try
see,
to,
so I
you
can
want to
see,
try
I
for
can
like a
see,
3-to-1.
I can see, you know, I can see the entries and everything like that. I just want to, that's why I'm asking you. I want to make sure that I'm paying attention to my stops as well. And I was, you know, in that video, I was listening to my man. He was talking about how tight his stops were. He kept
Mhm.
saying, "I cut it. If I don't get in, you know, it doesn't do what I wanted to do right away. I cut it. I cut it.
Mm.
I'm a tank. I'm a tank. You know."
What would his personality be? I forgot. It's something.
He would be,
A scared nigga.
I would say like a bit conservative, because he's not, I think conservative because like when you have a bigger risk appetite, you're willing to risk more to gain more. When you're conservative, you're willing to risk a little to make a lot. And so when you have like tighter stops like that, I would say that he was probably like a more conservative trader.
Yeah, he kind of said that he was, but that's kind of your approach, right? You're conservative.
I am conservative. Yeah. So if you're trading spot in the intraday, you're looking at like somewhere like the 1 hour 30-minute chart. And so if I make this a little bit bigger. So today, right? Looking at today's price action, we gapped down in the morning, right?
Yeah.
We fell into this demand zone. Price came down to about 371.04, right? This is a 2 down, 2 down, 2 up, right? This is a 2-2 bull.
Yeah.
In strat terms, right? So let's see, can I remove this? Let me just scoot this over for a second. I'm just going to delete it. It's just in the way. I'm going to remove that for a second. So your entry could have been here. So this would be our 2-2 bull entry on the 30-minute, right? Our stop could have been here at the bottom of this candle, or his name is Cyberdog. His stops are at the bottom of the candle that he enters on. So his stop could be like right here. So you have two possible ways to approach the stop. You can put a stop you can enter based on the height of this candle, and then you can put your stop based on the candle that you entered on.
How you gonna know if you're in a candle?
What do you mean?
I'm just trying to understand so okay, for the next candle, if the next candle that stop when you go into this next candle, your stop is gonna be
This one?
yeah.
Okay.
Because once you finish that candle, you're going to the next one, right? Your stop, if that candle was a bearish candle, and it goes down to the wick of that candle, to the previous candle, that's where you cutting out, right?
Well, let's just do one thing at a time first.
Okay, because yeah, okay.
The first idea is like, what's your entry, right? So we see a 2-2 bull entry. So that means that the moment that this is a 30-minute chart. So the moment that this 30-minute candle is higher than this previous candle, we want to enter the trade.
Right.
Now you set your stop. You set your stop at the bottom of your entry candle. That makes sense. So this has already been determined for you because it's higher than the previous candle. So this bottom here is, you already see it because it's going to be on the chart. That makes sense.
Mhm.
So price was at 372. It goes down to 371, right?
Why isn't that your stop?
It could be. That's what I'm saying.
Well,
it's
different ways
to
but
approach.
if you're getting into the new candle, you don't know if that's.
You do know, and here's why you know. So I'll write this. Let's say it's a stop.
And maybe I'm a candle late with this. I'm looking at it wrong.
So price goes down to 371.04. You got two down, two down,
Two down,
two up.
two
The
up,
moment
two up.
that this candle here, this third candle, goes above 372.33,
You're
you're
getting in.
entering this candle, right? Now, typically, you can see this wick at the bottom, right? Meaning that price was down, but then the bull stepped in and pushed price higher. The moment that bull stepped in and push price higher, you're in the trade. But you already also know the low of this trade. You know
Right.
the low point already.
Okay,
That makes sense.
it does.
With the high wick, we can tell that the bulls tried to press the price higher, but then the bears came in and pressed it back down,
Okay,
right? Now, when you see this next 30-minute candle start, you can adjust your stop to be at the bottom of this candle now.
Gotcha.
So now we have a new stop. So now this would be our stop right here.
I got you.
So that's our new stop, right?
Okay.
And now after this candle is going, now we have another stop. We can intra stop up, as we start to get familiar with like the process. So you
Okay.
intra stop up. So now we have another stop. And
Would it be
now
two-
we get to this inside bar, then you have this stop here. And so the moment that we breach that stop level, meaning that we go lower than that stop level, we want to exit our trade. So when we have an inside bar and we got a 2 down. The moment that this 2 down candle comes, below our stop point, we want to exit our trade.
Yeah.
So you got in at 372 and you would have exited at 374. Now you could have been like, man, I exited, but I left money on the table. And that's true, right? But you got a 1, a 2 down, and a 2 up. This is your 1, 2, 2 rev strat. So you could have got back in the trade a second time, right? This would be your entry. This is a 1, 2, 2 rev strat bull. This is 30-minute. This is your entry, right? And then you can have a new stop here. I'll make this stop yellow because it's, it's a bunch of lines down there. So now this could be your stop for your second trade. That makes sense?
It does.
So you enter based on this candle and you set your stop based on this candle. You enter based on the high of this candle. You set your stop based on the low of this candle.
Yeah.
Right? And so if you look at this, right, if I right click on this and click on duplicate, now we can see how we can gradually move this stop loss up. You see this?
Mhm.
And so essentially we're able to take our entry at 374.77 and we can get it all the way up to about 377.11 before we get stopped out potentially by this outside bar. Now, because it's the end of the day, I probably would have moved my stop to the top of this body here. So let me show you. So you duplicate. You see the top of that body there? And then immediately this candle came back down and tried to like, you know, take away some of your earnings. So we got from 374.77 and we could have taken it to 377.78. So that's a $3 move right there. So you had two trades that could have worked in your favor. Y'all see that?
Mm-hmm.
Yeah.
So you guys have a better understanding of how to enter and exit your trade based on your stock chart?
Mm-hmm.
All right, cool. Now there's another way to enter and exit your trades, and I'm going to show you based on the option premium chart. So if I scroll to the top, all right, so basically we'll look at today's premium chart. So we would have gotten at 372. If we understand the top of our demand zone is at 375, we could have got a 375 call. Does that make sense?
Say that once more.
You see, it's a two down, two up. So we had an entry at 372.33.
Right.
And we can see the top of this zone right here is at 375.88. So it's safe to say that we could have got a call for 377. So our thesis could have been the trade is going to be bullish and we're going to come out of the demand zone. That could have been our thesis for today, right? So we get a 375 call. So if I type in SPY 220715C375, we can see that at 10:30, that's when this became a bullish trade. And so looking at this option premium contract, y'all see this option contract for 375?
Mm-hmm.
You see how it's a two down candle, a two down. We got an outside bar at 188, and then price makes it up to about 459.
Mm-hmm.
So one of the ways that you can manage your stops based on the option contract is by percentages or by points, right? So if you get in at 188, you might say, okay, I'm going to spend 188 on this position, but I'm only willing to lose $40. That makes sense?
Right.
And so if you say I'm only willing to lose $40, then your stop is going to be at 1.48, which would be, let me just edit this. So it'd be 1.48, and then this would be a stop. Y'all see that?
Mm-hmm.
So if price increases and you have a profit, your goal could be, okay, I'm just getting started as a trader. I want to get consistently 10% gains on all of my trades, right? So if this contract grows 10%, you can say, what's 10%? Was it 0.18? So it's about $200. So if we get to, let's see, let's make this a little bigger. So we're looking at about 210, I think. I think that'd be 20%. So we go to about 210. This could be your exit price. This could be our 10% gain. Y'all see that? So when I talked about the Fibonacci retracement, where that comes in and it becomes very powerful is like, all right, you click on your tool, you go down to Fibonacci retracement, right? If our entry is at 1.88, then we know that 100% of that is going to be 3.6. So like 1.9 times 2 is 3.6. So we go to 3.6 and we press down on the mouse, and then we come down to 1.88 or 1.9. This right here is 100%. We know that whenever you have your entry price and you multiply it times 2, that's going to give you 100%, right? If your goal is a 50% profit, once the bars get the 50% line, you can exit the trade, whether that trade is still good or it's starting to go bad. That makes sense. So if you're getting at 1.88 or 1.9, your exit could be 2.75 because that is 50%. If your goal is 100% and you say, okay, my entry is 1.88 and I want to get 100% on this trade. Now things could have got a little bit weird right here between these two bars that went down, but then we had a rebound. As soon as we got to 3.6, you could have cut that trade regardless if it was still going or not. So basically what I'm showing you is how you can manage your trade on the option premium side and how you can manage that trade on the stock side. So based on the stock side, if I type in SPY, I don't know why it takes so long to load up. Let's see. So we can see how we can manage our trade based on the lows of each candle on the stock chart. And if we go back to that premium chart, we can see how we can manage this trade based on percentages on option premium chart. You guys understand that? Those two different ways to manage your stops and your exits.
Yeah.
Yeah.
All right, cool. All right, so now that we get that, we can swing into looking at how to set up your trade. So let's see. So going back to the SPY chart. If we see we got a 2-2 bull forming on a 30-minute chart, it's at 372.33, and the top of this zone is 375. We could look to enter a 375 contract. So I'll go to trade. I'll go down to the 375 call. I'll right click on copy. I'll click on charts. And where is it? So I can type in, I can click on Control V or Command V if you got a Mac. Click on enter. And immediately what I want to see is how much this contract is. All right, so we got a 30-minute chart on the left. Let's put on a 30-minute chart on the right. So we can see automatically that this chart looks like this chart. So if our entry is at 1.88, now for me, this contract is too expensive. So I would probably go to like a 377 contract because I don't want to spend that much money on my contracts. I'll type in 377. Now we can see it's a bit cheaper. We got 1.19 that could be an entry price. And so say I have, let me pull up the calculator. So say I have $1,000 in my account right? This is my brokerage account. I have $1,000 in my account. I only want to risk 50% of my account on any given trading day. So 1,000 times your 0.50 is going to give you $500, right?
Right.
So that means I have $500 that I could spend on one trade. So $500 divided by your 1.2, that gives you, what happened? $500 divided by $120. That gives you 4 contracts, right? So if I buy 4 contracts, that's 120 times 4, that's 480, right? So I could buy 4 contracts at this particular price. So now I understand how much money I want to risk. I understand how many contracts I can buy. Y'all got that? We could buy 4 contracts. We understand what our entry price could be. We understand the law of the contract as well. So the contract, the lowest point is at 0.88. So you're risking about, $30 right there. So now I go to trade. Well, actually, you can right click here. So you have your option premium chart. It says 2.99. Now, when this trade is active, it would say 1.19. It wouldn't say 2.99. So this price will reflect whatever the price is currently. Y'all get that?
Yeah.
All right, so you right click on here. So right click and you go to buy and you go to single. You're going to see something pop up at the bottom here. I see this?
Yeah.
All right, cool. So if I know I want to buy 4 contracts, what I do here is I click from 0.1, this is your quantity of contracts, and I take it to 4. Y'all see that?
Yeah.
Now it tells me this is the SPY chart.
Yeah.
It expires July 15th. It's a 377 call, and this is the current price. The price would be 1.2, but because the market is closed already, it doesn't reflect that, right? Now, you have 2 types of orders. You have your limit order and you have a market order. A limit order says that if I change this price to be like 1.15, the limit says if all right, so think about this, right? Price is at 1.19. If I say I want to wait for price to get down to 115 and then execute, the limit says price has to be at 115 for this order to execute. Sometimes price will go down to like maybe like 117, 116, and it might not hit 115, and then your order will not execute. That makes sense?
Yeah.
Now, there's times when I've been in the market and I've used the limit order and I wanted to get into a trade and I got left because my number was not hit and my order did not execute. Now, to make sure that your order executes no matter what the price is on order, you want to click on this and you want to go to market. Now, what market means is that the moment I press confirm and send,
It's going to buy it.
it's going to buy it no matter if the price is 1.2, 1.25, 1.3.
Yeah.
But I'm willing to risk whatever that number is because I want to be in that trade no matter what. And so for me personally, I always use the market order, right? Now, there's a way that you can save this as an order template. If I know I want to always buy 4 contracts, what I'll do is I'll click on this settings icon. Is it this? Not that one. Sorry. It's this icon at the bottom. You see where it says the delete button? And then to the left of that, you have the save custom order.
Save custom.
So you click on this. Where is it? I click on it and you see it says for market. So I click on save.
Okay.
And so now when I right click on the price point, I can go to buy custom and I can click on for market. And it's going to populate at the bottom.
Show me that one more time.
So if I close this out, I can right click on my option premium contract price. instead of going to buy, I can go to buy custom.
Okay,
My template to save that. And I can go down to 4 market,
got it.
and then it's going to pull up 4 contracts at the market price.
Got it.
All I have to do is wait for my confirmation on the chart, and then I'm going to click on confirm and send.
Okay.
That
But
makes
you
sense.
can always adjust it in that at the bottom. Let's just say, you know, you wanted instead of 4, you wanted to buy 5.
Oh, what happened here? Something happened. So you right click on buy custom, click on 4 market, 370. You want to always verify that you have a SPY option contract and it's not the actual stock. Because instead of spending 119 on the option premium, you could actually be buying 4 contracts for SPY at 377. 3 stocks, 3 shares of stock. 4 shares of stock. That makes sense.
Yeah.
So you want to always confirm that you have SPY, your expiration date, and your strike price. You click on confirm and send, and then it's going to bring you up this window here. You can see it says buy 4 SPY contracts. This is your expiration date. This is your break even price. You have an infinite max profit. Because currently this price is at $3, 3 times 4 is $1,200. And so your max loss is going to be $1,200. That doesn't mean you have to lose $200. You can have a stop in place.
That's your
But
max.
it's showing you that's all you can't
If you didn't manage to trade it all, you could lose that
more
much
than
money.
1,200. What'd you say?
Yeah, if you didn't manage to trade it all, you could lose all that money.
Exactly.
Okay.
Exactly. Yeah.
Where did you see where? Can you show me again where it's a where this is a call versus stock? I didn't see it. I didn't see where.
At the bottom here. So if I right click on the stock side and click on buy custom 4 market, it'll just say SPY has ETF.
Okay.
Right now, if I click on the option side, I right click, I go to buy custom, I click on 4 market. Now it says SPY, your option expiration date, your strike price, market, and then it's showing you you know, how much it's going to cost.
And now that's an option. That's an option purchase. If it just said ETF, that would be a stock purchase.
That's right.
Gotcha.
Now, something else, that's one order template, right? That's only buying the market. Now, I'm going to show you guys how to set up an order template with the stock price already embedded into it. Okay.
Let me ask you this: after you've gone, let's just say that you've gone in and you just used the template, right? You can adjust that template and change it back, change the amount of contracts, or change it to a stop buy in that same area, right?
Yeah, you could. Yeah.
Okay.
So if I right click on my option premium contract, I click on buy custom. I go to 4. So you see it on my side, I got one market, 2 market, and then I got 4 market, right?
Got you.
So if I decide I actually want 2, I'll just hit the down button twice, and then I got 2 contracts. If I decide I want 10, I can actually like highlight it, and I can type in 10. Y'all see that?
Yeah.
All right, cool. Yep. So yeah, that's how you do your market order. What we can do now is click on this settings icon. What do I want to do here? Nope, I don't want to do that. So if you right click on this order and you click on create opposite order. Oh wait, that's not it. I figure how you do it. I never set a manual stop. I always do it myself. So create duplicate order. No, didn't work out that way. Which one is it? 1 second, please. So if you go to buy custom and you put with stop, it's going to give you a buy order and a sell order. So you can say, I want to buy at the market value. This would be a market.
Yeah.
So I'm buying my SPY option contract at market value. And this stop is going to be based on your option premium contract. So you can say that I want to sell this contract. If
What was that
price
stop? Our
at
stop was one. I don't know what that is. What is that? Price?
1.19, and then our stop could be 0.88.
0.88. Yeah.
So you type in 0.88. And the only thing is you could save this template, but you don't want 0.88 to be a stop every time
Right.
you execute this template. So you don't need to save this as a template. Basically, what you do is you right click here on the price, you go to buy custom, and then you go to buy with stop.
Yeah.
That's how you add in your stop. Now, you can click on the settings icon. So you click on the settings thing, and then you can set your stop price based on, what is it? So if our stop price is, so if we first got in this trade at, how do I make this smaller? So if we got into this trade at 372.33 and our stop was at 371.36,
Mhm.
let me just show you this again. So if I'm going to delete this out and we're going to start over so you guys can see the whole workflow. So we right click, we go to buy custom with stop. You want to set this to market. And then when you get to the bottom where it says sell and you want to set your stop price based on the stock chart and not based on the premium chart, you're going to click on this settings icon and you're going to come down to where it says your conditions. You want to submit this when the SPY chart, the SPY symbol is less than, and you type in, what is that? 371.36, no, 371.36. And so basically what this says is we want to sell our contract when our SPY chart is less than 371.36.
Okay.
Right? When you come down to the bottom, it says a description. One of the things to also consider is that time in force is day. You want to make this good to cancel. So GTC means good to cancel. And so basically what that means is that if you got a SPY contract and its expiration date is on a Monday, a Wednesday, or a Friday, basically it's like not today, this stop loss will be in effect until we get to that particular stop level. That makes sense? I just said a lot. Let me know if you
You
guys
did.
think that.
Here's where I want you to start again. Show me again where you went in to create this stop. I just need you to run at it one more time. I'm sorry.
Yeah, no problem. So let me delete this.
I got where you go in and you
So you right click,
right click, buy custom with stop.
with stop. You want to make sure that this top buy contract is going to be a market order.
Yeah.
Mhm.
And then your stop price can be based on the option premium, but we want to base it on our stock chart. And so you click on the settings icon for the stop one that says sell. So on the red one, click on the settings icon. You want to click on at the bottom here, well, it says sell. You got your quantity. You want it to be a stop price. You want to click on unlock here because we don't want that to be in effect. And then we want to come down, time enforce, make this good to cancel. And here we want to type in SPY, so it comes up automatically. Mark is less than, and then we type in 371.36. And so at the bottom here, it says submit the following order. So sell my one SPY contract. When the ask price is below 2.98. Why is it saying that right there? Don't want that one. That's why it's easier to just do these manually, because this screen things can get a little spooky.
So how would you do it manually?
So
put
by manually, basically what happens is like I can set an alert. So if my entry is at 372.33, I can set an alert. So I'll go down to create an alert. And the price point would be 371.36. So it says mark is at or below 371.36. So I'll say like get out the trade here. That would be my alarm, right? I click on create. And now whenever price goes below that level, I'll get a notification. The moment I get it, I'll pull up my trade and I'll exit the trade. That makes sense.
Yeah. Show me how you would exit the trade.
That's the only thing. Like if the market is not open right now, so I have to show you like during the time when the market is open. So
Okay.
like, say like Monday comes around, and you know, I could be probably like available like around 10:30 or like 11. If you're available, Randy, I could walk you
Okay.
through how you get into a trade and exit a trade.
Okay.
But I can't show you because you have to be in a trade in order to exit it. And so just like you right click and go to buy custom and you do like for market, right? Instead of buying these, I can click on from buy, I can go to sell and then just confirm and send. And that's how I'm not gonna click on send, but that's how you would sell your
Got you.
contract. Yeah.
I got you. Okay.
Yeah.
I may do that just to see how you Monday.
Yeah. So
I don't
again,
know how busy. I don't know how, are you trading Monday?
I think I am, but work has been really busy lately. So I just got to check my work schedule to see what's going on. But we can definitely do a trade.
Or if you I don't know if you can record it.
Yeah, I can record it. That's fine. This is recorded too. So everything that we're going over right now is recorded.
Okay.
Yeah. So just to refresh, right click, go to buy custom. I can click on to market. I can buy at the market price because that's my template. And then say I make some money, price goes up. I right click on this. I go back to, I can go to sell custom and go to market. And now I'm selling those two contracts that I currently am holding.
Obviously, we got to create those template stuff ourselves.
Yeah, it's pretty simple.
Okay. No, I got you.
Now, the last thing I'll show you guys is how to use a trail stop. Trail stop is like pretty cool. I don't always use trail stop, but I think it's good to know anyway. So I'm just gonna clear this out.
Let me ask you this. Even though the SPY ETF chart, even though the options chart mocks the stock chart, why do you want us to actually, or why do we actually Why do we actually go in and sell based upon, why do we place our stop based upon the stock chart? Is the options chart that much off? It looks like it is, but
That's a great question. So an answer would be, the reason why you want to base it off the stock chart is because the option contract can be very volatile, meaning like you could be down 20-30% on your contract and you might panic, but you haven't actually hit your stop loss on your stock chart. And so sometimes, you know, this chart can move, it moves pretty much similar to the stock chart, but say for example here, right? I think like we're right here. So you could have entered this chart at 119 and price could have got to about 205, right? Now, looking at this chart, you have a stop at 373.43, right? Now, based on the option chart, you could have got back down to 1.19 a little bit lower. You could have gotten out of that trade pretty fast, right? You could have been like, oh man, you know, it breached my stop point. I'm getting out the trade, right? Same thing happens on the stock chart as well, but it's a bigger wick here, meaning that price came down, but then it quickly went back up. Whereas here, you could have saw this hit and you could have just got out your trade immediately. And so when you do this based on your stock chart, you have a better representation of a stop loss versus just looking at how price is moving on your option premium contract. And so I would say that, well, I use the stock chart for my stop losses versus using the option contract for stop losses because it helps me have a better understanding of like where I actually want to get out my trade at. But, you know, as you start trading, you start paper trading, I don't know if you might lean more to like stops on the option contract or lean more to stops on your stock chart. So it's really about preference. It's really about like your preference and your risk tolerance. You know what I mean?
Mm-hmm.
Cool. Let's see. All right, so trail stop. Let me show you guys trail stop. So the way that trail stop works, trail stop can be based on points or it can be based on percentage, right? So I entered this trade at 1.19, right? And let's say my trail stop is 10%. So 10% of 1.19, that 10% would be like what, 11 cents? Yeah, about 12 cents. So my trail stop would be about 1.07. Is it there? So this could be my 10% trail stop. So right now, what I'm showing you guys is how the trail stop works. It's one more order template that we could set up. So trail stop is always going to be 10% lower than what the current price is. And so if price moves from 119 and now is at 1.57, your trail stop will be at 1.57 minus 0.15. I don't feel like adding. I'm tired. Let's see. So 1.41. So our new trail stop will be 1.41.
you don't use it, but you said you aren't using the trail stop.
I don't always use it. No, it's a good tool to use when price action is going really crazy. Like we get to 2.05. It's that 1.80. So our trail stop would be like 1.85. And so your trail stop, it moves on its own automatically, which is why it's a good tool to use.
Yeah.
And so basically what's happening here is that if we enter our trade at 1.19 and we have a 10% trail stop, our trail stop will be at 1.07, meaning that if price goes anywhere below this 10% threshold, our trade is going to exit. Now, say price action goes to 1.57. Our trail stop is going to move by itself to 1.41 because it's 10% less than current price action, right? So if price goes anything below 141, we're going to exit this trade. Now you can see with this next candle right here, this next candle, we actually go below that trail stop. So we would have exited our trade at 1.41. You see that? Because the wick goes down. You see this wick?
Mm-hmm.
Now, if we're able to stay in the trade and price goes to 205, our 10% trail stop will be 1.85. So the immediate next candle comes straight through that 185 level. Our trade would have exited immediately. Y'all see that?
I see it. I mean, it sounds like a real safety. Net, which is a good thing.
It is a good safety net. It is. It's a good way to protect your capital. And so you guys understand how that works, and I'm gonna show you how to set up the template.
But it's gotta have some sort
of. Yeah, I get how it works.
It's got a con, doesn't it? I see the pro, but wait, is there a con associated with this?
The con associated with it is that, like, remember I was saying that the option chart pricing moves a bit more volatile than, say, the
That's what I was thinking.
Actual stock chart. So it would keep you out your trade. So like, say this bullish candle here, right? So strong bullish candle for the 30-minute, right? Now, would you have been able to get all of this price movement? Maybe not, because, price could have, moved a bit volatile on this side and it could have knocked you out your trade. So like on this candle, we could have got to 1.57.
That's a 30-minute chart. So inside of that 30 minutes in that candle, if you was to zoom in, that shit could be something crazy.
Yeah,
that's true.
Be.
So if we
I'm just saying you might could see that maybe within the 3-minute candle chart or whatever.
So this is the 15-minute chart right here, right? So you can see like more candles. I'm gonna go to 15-minute on this side as well.
Where was we at 11 o'clock or something? I think.
I think so. Yeah, about 11 o'clock. This whole, what is this? These two bars here, that's your 30-minute candle.
Mm-hmm.
And so if I zoom out on this, yeah, you can see we had this nice move up to 1.57.
Mm-hmm.
Our trail stop would have been at 141. And then when this next candle started, it actually went down a bit, right? And then the bulls came in and came through this level. But when it went down below 141, you would have got knocked out your trade.
So yeah, okay.
You see that? So actually, you would have got in the trade at 1.19 and you only would have made $20. So you got 119 and you got 141. That's about $20 right there. Versus if you had a manual stop, just like a mental stop, you'd have been in your trade, and you can see that you probably would have been able to stay in your trade a lot longer and get more profit. Y'all see that? Before getting kicked out. So the trail stop can be useful. You can use 10%, you can use 15%, 20%, like whatever your threshold is.
Seems like it might be best if you're not sitting there managing the trade. Like if you aren't sitting there watching it, like if you have to step away, if you got a meeting.
Say you have to run to the bathroom and you I don't want to miss anything crazy, you would set the trail stop on that.
Right.
So like how you do this, you right click, you go to buy custom with stop. And so at the top, we got our buy order for one contract. We're gonna set at the market price. And at the bottom, instead of clicking on stop, we click on stop and we go to trail stop. we set this based on, so you see this plus and minus sign here?
Right.
You click on that and you go to percent. And then you would just do 10%. And so we can basically what we're saying, we want to buy one contract at the market order and we want to sell one contract at a 10% trail stop. And so you save this by clicking on this button right next to delete. Click on that. And you just say one market. And then you say 10% trail stop. You click on save. And now if I close this and then I go to right click on this trade, go to buy custom, this very first one market with a negative 10% trail stop, I click on that and it brings my order back up. Y'all see that? We got a market order and we got a trail stop with a 10% risk. And then when we click on confirm and send, it's showing you that, where is it? It says buy one contract, expiration date, market, and then you're selling one contract, has the expiration date, the same contract, it has trail stop, tells you negative 10%. I see that?
Yeah.
So you want to always make sure that this reads and it makes sense based on what you want to actually happen for your portfolio.
Gotcha.
So yeah, that's pretty much it with that. One other thing I want to show you guys is like how you would document your trades. So I'm going to send you guys a spreadsheet for how you can document your trades. But basically, a quick way to document your trade is to say like, I typically use the time level. So when you go to your tools, you'll see like you have the price level here and then you have your time level that's diagonal. So you click on time level.
Mm-hmm.
If you get, let me go back to the 30-minute chart. Actually 15 minutes fine. We got a 2 down, inside bar and a 2 up. So we can enter this trade at this level here. And then say we see this inside bar and then we break the low of that inside bar. So that would be our trade on 15-minute chart, right? That's our trade. Now we come over here and we basically see we got in at 10:37. So we click on edit properties and you can adjust the time manually like that. Click OK. And then we got out the trade at 12:07. So then we go up to click on, tells you the time at the bottom. So you see, go down to 12:07. And then basically what I would do here, I would just do a screenshot. So let me just move this for a second. So I would just do a screenshot. And then I just open the screenshot on my computer. And now this is an image. And like basically I would just type on this note. So I don't know how it works for PC.
Mm-hmm.
But basically I can just like make a note. So let's just make it white.
So this is kind of was going to be my last question before we wrapped up. Is
So
this the best way? Huh?
I'm listening to you. Go ahead.
No, I was going to say, maybe the next, say, 4 weeks. I mean, I know you and Randy just discussed something about Monday, but for me, I was wondering if I start just going through it myself in the paper money account, and just taking some contracts and going through it. Like, could we maybe get together maybe for an hourly rate or something like that, and just go over what I've done, let's just say in the next month? Would would this be the best way to do it, or would we just share a screen and just go back to it, or should I screenshot it?
You can screenshot it and we can go back. So we can do both. That's cool. And so you like just get familiar with the process.
Yeah, that's just like I said, give me like 4 weeks to just, and we just go in, Zoom it, share the screen, and just go in, look at it, see how much success is, see what my errors are, and things like that.
Yep, that
Yeah.
works.
Yeah.
And so what I do, I'll take a screenshot and I'll make like a little note. So like we have different things like shapes. So I can grab a shape and I can say like I insert here and then copy and paste it. So like this could be my screenshot. You see what I'm saying?
Mhm.
And I can come up here to the premium chart. And then basically we got an entry at 1.19. We got an exit at 205. I can also put like my entry price, my exit price, and then my profit. And then I would just save all my screenshots in a folder and just look at them to see like what my mistakes are. You just rock like that. But the next thing I'll do, I didn't do it yet just because I've been really busy, but I'll make a spreadsheet for you guys for your trade journal and you can just enter all your trades in there manually. So it'll be, it'll be like a couple columns on the spreadsheet. You'll have like your entry price, your exit price, your number of contracts, the date. And that way you can keep track of like how much money you're making while you're practicing on the paper trading side.
Cool.
Cool.
Sounds good.
All right, cool. I know I went over a lot today. I recorded this session so I can send it to you guys and you could just like, read back through it and, do your thing. If you guys have any questions, like, during a trade day and you want to like revisit some things, just, let me know and I'll hop on Zoom and we can go over your trades and stuff like that.
Okay.
If you guys have any questions that come and you want some clarity, you can hit me on a Discord channel. I know you guys don't typically type in a Discord channel, but you can type questions in there and I'll see them and I can respond back, or we could just like hop on a Zoom, okay?
Okay.
All right, I know I went through a lot today. We went through the option chain, we went through the analyze tab, and we went through how to set up the order templates.
No, that was all good.
questions? Any questions that have come up maybe since I've been talking that you guys might have thought about?
No, I mean, I don't have any questions. I mean, obviously, I
No.
got to work it, implement it, and so forth. Again, like I told you from the beginning, I learned by playing around with it. So that's why I said in the next couple of weeks, I just want to really just start, submitting some trades and see what happens.
All right, cool. Now in the paper trade side, I think you guys got like $100,000 to play around with. The only thing is on the paper trade side, I think the data might be a little delayed.
Right.
So let me show you. So you see how right here it says real-time data?
Uh-huh.
So one of the things with Thinkorswim, if you put $500 in your actual account, you'll get real-time data on a paper trading side. That doesn't
Right.
mean that you're going to spend the $500. It just means that it's in the account and it'll give you real-time data. So that's something to consider, before you guys get started, put $500 into your trade account. And how you would do that, once you guys get ready to do that, I can walk you through how to set it up.
Right.
And we can just get going like that, okay?
Cool. Is it hard to do? Just to fund the account? Is it?
No,
It's
you
not-
just go to TD Ameritrade. Let's see.
Yes. And you just link a bank account, right? It probably takes a couple days or something like that.
It takes, they say about 5 days, but sometimes it gets in there immediately. So you just log in. Once you log in, you can add your account, and then you can do a wire transfer from your bank account to your TD Ameritrade brokerage account. It'll take about 3 to 5 days to process. But after it processes, you'll be able to get that real-time data, wherever it is. Yeah. It'll say real-time data right here. Cool.
Cool.
All right. Well, if you guys don't have any questions, we can wrap up. But if we still got 10 minutes. If If you guys want to go over anything specifically and look at any other kind of charts.
No, I mean, you showed us today how to simply execute the actual trade going into it.
Mhm.
You know, using the good control V, you know.
Absolutely.
Now that was good. And then I can come back to this video.
Yeah. Yep.
Yeah,
Cool.
yeah, I'm good. I'm good.
All right, guys.
All right, thanks. Have a good one.
All right, y'all have a good one. Let me know if you have any questions in the Discord channel. Hit me up, okay?
All right, no
Okay.
problem.
To-
Right, take care.
Discord and we can still shoot the text, right?
The text is fine. That's cool.
Okay.
Hmm.
Okay. I'll probably put it in my Discord though.
All right, cool. That works.
All right, thanks. Take it easy.
All right, see ya. Yo, Mike was fast. He out of here already. All right,
Hey,
Randy.
Monty, thank you. I appreciate you. Thank you.
Yeah, no
Thank you, thank
problem. Let me know if you
Tonight
got
was
any.
tonight was good. Tonight was real good. We went over a lot of information. Tonight was good.
Okay, cool.
Okay.
All right, I'll
right.
keep on sharing resources in the Discord channel. So I'll share some more YouTube
Okay.
channels and things like that.
And I'll be looking out for the journal.
Yeah, the journal. I'll send you a spreadsheet.
Okay.
All right, cool. Have a
Thank
good
you.
night.
Thank you.
All
I'll
right,
talk to you.
peace.